Well, hi there, my name's Chris Weston, Head of Research here at Pepperstone, and we're going to be talking to you today about what's going on for the week ahead. We've got company earnings coming from the US, so more micro factors may play into this situation. But of course, we're coming off a massive weekend of geopolitical news flow. We're all trying to come out with the best takes about what's going to happen with the Israeli-Iran situation, what this means for energy costs and those kind of factors as well. And certainly the market is seeing some high volatility. But we've also got some other sort of more traditional macro factors that are playing in. You know, what's going to happen with US rate settings? Are we going to see any interest rate cuts coming forward? We've got a rampaging US dollar and all these factors which could potentially drive from a data point of view. So let's go into the week ahead. But first let's go to the disclaimer for compliance purposes. Well, we're here, another big week ahead for traders of all different types, whether you're a swing, position trader, certainly scalpers, day traders. There's a bit of volatility playing through in the market. So I think what we want to do is have a look at, first of all, the platform by which we're looking at and staging ourselves to go forward. Obviously, we look forward as traders rather than backwards, but let's have a look at the platform that we have to work with going from the situation so far. I want to have a look at equity markets, and you can see here on the Bloomberg charts, the last 5 days, the Dow was under a bit of pressure, down 2.4%. Now, that's going to be an interesting market for anyone out there who's trading the US 30 with Pepperstone. Do understand that United Health are going to be reporting on Tuesday. Not a stock necessarily we'd see a huge amount of business in because it's a health stock and people like to see more sort of growth, more sort of higher beta plays. But it does have a 9-10% weighting on the US 30. So 10% of the variance of the market is reporting on Tuesday. So something for anyone who's watching or trading the US 30. The biggest stock by its price, but in terms of the contribution towards the weighting on the index, will be reporting on Tuesday. So a major decision for you guys to look at there. The S&P down 1.6% on Friday. We'll have a look at the technicals in a second. Nasdaq outperformed a little bit. Some of the Mag 7 stocks are holding in pretty well despite some fairly shaky moves towards the back end of last week. You can turn to Asia. We've got the Nikkei down 60 basis points, 59 basis points on the week. So a bit of outperformance coming from some of the US markets. And you can see actually the Chinese market up about 20 basis points. So that's where we saw the outperformance coming through. Also, the FTSE did very well last week. I'm attracted to things that like to sell stuff that's weak, and I like to sort of gravitate towards stuff that's strong. I think very a simple way of looking at that. Now, the FX market, obviously the big focus last week was on this policy divergence that seems to be taking place in the US dollar. You can see the US dollar, if we have a look at the Dixie, the DXY, which is a basket of currencies against the US dollar, 57% weighted towards the euro. The US dollar is obviously on a rampaging situation. Now, part of that is also down to the flight to quality that we've been seeing. Towards the back end of last week, there was obviously a lot of geopolitical headlines that coming through that we were waiting imminently for an attack from Iran on Israeli soil, and certainly that's played out. But you can see that the US dollar has certainly outperformed. We had the best week in the dollar index since September 2022 last week. It's really strong, and I think it's strong for a reason. There are a whole number of factors that are offering it tailwind. So, I still want to take a fairly positive and constructive bias on the US dollar. You can see most of last week that the gains were against the Swedish krona, and I still like dollar stocky higher in the short term. Maybe wait for a bit of a pullback. Have a look at the charts in a second. You can hear some of the high beta plays playing through. Bit of unwind of the carry trade last week with high volatility playing in, but you can see the Chilean peso, which would probably benefit when that reopens a little bit later on, because we are seeing copper prices absolutely flying. Obviously, the weekend news that the LME is looking at removing the listing of nickel, aluminium, and copper from the exchange, just for Russian listings. There has seen some staggering moves this morning in some of the LME metals. LME copper, LME aluminium is absolutely flying, but certainly copper looking very strong. And the Chilean peso has the strongest beta to the copper price of any currency that I can see in global FX markets. So certainly, if we're seeing a high copper price, you'd expect to see the Chilean peso doing very nicely there. But you can see some really good. You can see last week actually this kind of strong move back towards the sort of the lower, the anti-cyclical, should we say, the safe haven currencies, the dollar working well, the yen working well, and also the Swiss franc working well. Look, rate differentials, absolutely. We'll cover that in a second. If we have a look at a couple of the drivers of the dollar, which we can go in the technicals, but I want to cover this question there. Wollongabba. If we have a look at rate differentials, I'm going to have a look at all parts of the curve, but you can see if I just use simply the 10-year US government bond, the US Treasury, and look at the premium, the yield premium over German bonds, just using this as a proxy of European debt markets, that you can see we've now got a 219 basis point premium of US government bonds relative to German debt. Now, we can all go through different parts of the curve, but you can see this is absolutely flying. I think this is a really good proxy of looking at this kind of differential trade that's playing through. I can also see the German Bund as well. If we have a look at this relative on a real basis, so we have taking the nominal bond, the US Treasury, which is just the normal bond, and we adjust this for inflation expectations, what we call a real rate. You can see that I've actually got this the other way around. You can see here there's been a reasonably good relationship between the two. So you're seeing the German real rate underperforming, or yields moving lower relative to US debt. And effectively what that means is that people are looking at the real cost of capital and they're seeing higher rates, relative rates in the US versus Germany on a nominal basis and on a real basis as well. So you can clearly see that as inflation expectations have been moving up, as bond yields have been moving up in the US relative to other markets, we can see that the US dollar has been working really nicely in that situation. We can also see in rates markets, last week obviously we saw a very, very strong CPI number relative to expectations, and certainly on what we call the supercore element, which is the services number ex rents, that came out at 65 basis points. So the supercore number is moving quite remarkably higher actually, and it's a bit of a concern for people out there who are looking at sort of the right tail risks of markets and saying, look, we're fine with growth, but if we're seeing higher inflation, then that really poo-poos the idea that we're going to see a rate cut anytime soon. And if we have a look at the white line here, you can see the number of rate cuts that are discounted into US swaps markets. We talked about this many, many times on this show, but beginning of the year, we were pricing in 170 basis points of cuts in January. Obviously, there was a lot of people being quite overzealous in that situation there, and you can see that was nearly just under 7 rate cuts being priced in. I think people were pricing in a pretty dark time in the US. That's now standing at 45 basis points of cuts. So there's been an aggressive rates pricing. You see the US dollar has gone up with that as well. So we can look at it on a relative basis, which is what sort of Walling Gabba was talking about there. But you can also see on an absolute basis, just looking at the US in isolation, that those rate cuts have come out of the market quite aggressively, because we've seen 3 above expectation CPI numbers now, and you can see 45 basis points, just under 2 rate cuts, and you can see the US dollar has benefited from this. So we've seen rate cuts coming out of the US. To me, I know we've got 4 CPI numbers until the July FOMC meeting. If we get another strong CPI number, a big PCE number coming through at the end of this month on the 26th of April, it's going to be very difficult for the Federal Reserve to cut rates, before the election. We're going to have base effects kicking in as well, because what happened this time last year, we're starting to get into a point where inflation numbers in the US were very low. And so when we work on a year-on-year change, what we're going to see is that the base effects are going to lift inflation numbers, or at least become an impediment to the downside. And so we're working on higher energy costs feeding into headline inflation, base effects. We're coming into a general election, a US presidential election, and the Federal Reserve have never cut rates in the month before a presidential election. So it does feel like the chance for a rate cut is slowly slipping away, which again is supporting the US dollar, both in absolute terms but on a relative basis. And we could also have a look at the data. So what we've got here is the economic surprise index, which looks at the data in the US relative to the outcome, or the data, how it's coming out relative to the street's expectations. And you can see the white line is that it has been moving up. So the data in the US has been beating expectations on a reasonably consistent basis, and the US dollar has sort of gone along for the ride there. So there's an exceptionalism story, which again is supporting the US dollar as well. So there's a whole sort of multitude of factors that are playing through. It's a bit of a magical currency. You've got higher inflation. You've got a relatively better economy. 280,000 payrolls have been created on average per month in the US this year. You've got a central bank in Europe who basically told us that they want to start cutting rates in June. The same with the Swiss National Bank. They've already started cutting rates. They'll go again in their June meeting. The Bank of Canada are pretty much saying that they're going to start cutting rates in June. Bank of England probably a little bit further out. But you can see there's an exceptionalism story. There's a whole multitude of factors which is causing this strong trend to take place in there. And if I have a look at volatility in the markets, we can see for the day traders out, for the short-term traders, we are seeing higher ranges and higher volatility. You can see that in the FX market. If we have a look at the G10, the big 10 FX currencies, and have a look at this implied volatility measure, which JP Morgan put together, you can see that we've come off very, very low levels coming back in March. And we're currently trading now at 7.79%, which is the highest levels really since January of this year, which we're getting pretty close to the highs of the year, which is good. A bit of life back into FX markets. Everyone who's a short-term trader likes that situation. Well, most people do, unless you're staunchly a carry trader who works for an FX bank, which not many people really do that outside of the institutional world. But you can see here the VIX now currently trading at 17%. It was up at 19% on Friday as people look to hedge some of that exposure going into the weekend because of the geopolitical headlines we've been seeing. And you can see gold implied volatility, or realised volatility, coming up to 17%. So what the point here is that we are seeing bigger ranges. We are seeing the movement away from an average has been moving up, and that creates opportunity for the short-term traders. It's not too punchy, but at the same time, there's a bit of life and a bit of range, which is causing some better trading environments for a lot of traders out there as well. What have we got on the radar this week? Let's have a look at the next stage, which is the landmines ahead. I want to bring up, let's have a look at the economic calendar for the week ahead. So we don't have a huge amount of economic data to drive. Obviously, we're going to continue to watch what's happened in the geopolitical headlines. Obviously, there's a lot of focus on Israel at the moment and whether we're going to see a new counter-offensive coming through on Iran again. What that looks like, it will be on the cyber attack. Will it be something a bit more physical? We don't know. And I think that's probably supporting gold market to an extent today. But yeah, obviously that's going to keep us on edge and trying to find out whether or not something happens around that. That could be something that traders may need to aggressively react to. We'll have to see, something that we are watching very closely. Remember, when it comes to a lot of these geopolitical headlines, we are very poor at pricing risk around these situations. I'm not a military strategist in any capacity, but we're just trying to understand, is there going to be, what's the propensity for a supply shock or some sort of impact that hits the Straits of Hormuz further down the line? We're trying to price risk, and so it's not something that necessarily we're brilliant at doing. But from a data point of view, probably the big one is the retail sales numbers coming through tomorrow night. The market's expecting a little bit of a moderation in the pace, 40 basis points there. If we have a look at the control group, which is the basket of goods that feeds more directly into the GDP calculation, expecting that 0.4%. So I think any number than that will probably support the US dollar. Continue to believe that we've got this exceptionalism story. Got a bit of tier 2 data, housing starts, building permits, leading index. But I think probably the point that we're going to be watching here, now we've seen that inflation number, we do have 15 different Fed speakers playing through this week. The timetable, as you can see, is coming through. Maybe probably one of the more important ones there is going to be Jerome Powell speaking on the 17th at 3:15 for anyone who wants to get up at that time. For in Australia, obviously, if you're based in the US, that's a slightly different situation. John Williams might be quite interesting. But I think, you're watching these speeches to see this idea about 2 cuts that are now being priced in. Has the market got a little bit far ahead of itself? Is there more to come? That's something we're watching very closely. If we go into the UK, Australia, let's start in Australia. We go around the grounds. The big one on Thursday, the employment number. Now, we've got employment data in Australia. I'm not expecting this to have any kind of major shift in Australian rates. The market, I think economists just sort of cherry pick numbers here, but we've got 10,000 jobs expected on a net change basis. The unemployment rate, which I think is probably the thing that the Aussie will look at more closely, expected to tick up to 3.9%. Obviously, the outcome of where a 4 handle will be very much dictated to by the participation rate. So the market is actually expecting a bit of an upside lift in there, which may weigh on the Australian dollar. We'll have to see what happens with the outcome. But that's the question is for us as traders, if you've got running an Aussie dollar exposure, would I be concerned about holding it over the unemployment data? Maybe, maybe not. I might take a little bit off the table because you might get a 20, 30 point move. Depends how big your position size is, obviously, and the leverage you're using. If we have a look at China, there's some interesting stuff coming out of China this week. We've got GDP numbers, obviously backward looking in its very nature. I'm never really too concerned about GDP. But I think China is probably the exception when it comes to GDP calculations and movement because, obviously growth has been a major consideration for them. It is on the rise now. We are seeing better data playing through. But the one I think probably you want to look at is new home prices and used home prices. Obviously, the property market's been very much in focus. There's no consensus here, but you can see on Tuesday at 11:30 Eastern Standard Time, some of these property numbers are going to be coming out. We do get the residential property sales later this week. I think that could be another one to watch out for. So some of the China data is looking pretty interesting. We'll have a look at the chart in a second. UK, do keep an eye on some of your pound exposures. We'll have a look at the charts there. CPI numbers playing through on Wednesday. That could have bearings on what's happening in UK rates. RPI, retail sales, but it's probably going to be a CPI number, which is clearly the big one there. If we actually have a look at central banks there, we've got a huge amount of speakers, including Andrew Bailey. So again, something we are watching very closely. If we're talking about central bankers, have a look at this. It is a central bank fest. In Eurozone this week. Have a look at this. 16 different ECB members speaking. All of them different views, but the ECB have pretty much cajoled the market to believe we're going to start seeing rate cuts coming through in June, which again is weighing on the euro as well. So that's really the big week. We've got central bank speakers from the Swiss National Bank, from the Bank of Japan. So there's the major factors that we're watching for the week. Also towards the back end of the week for you Bitcoin traders, obviously, I think we can bring up, I'm charting the markets. We do get the halving coming through. I think it's we've got 5 days till the halving. So I think different reports obviously have different stages. We need to get through though in 210,000 blocks. So people's estimation of when the halving is going to take place is obviously there and maybe different. But we're looking somewhere around 5 days until the halving comes through. Now, if we have a bring up my crypto charts. We are seeing a bit of reprieve back in. Obviously, the market got hit pretty hard on Friday and into Saturday morning. But we're just regaining some of those moves that we've been seeing playing through. And obviously, the last 3 halvings that we got, what was it? November 2012, July 2016, May 2020. We did see a little bit of weakness playing through in most of those cases into the halving. But then, in the 10 days after the halvings, the average move was about 6%. So, what we're going to see is that Bitcoin miners are going to find it more troublesome to... the difficulty rating is increasing and to try and get those blocks and the rewards. But the reward itself is going to go down to 3.125 Bitcoins that they're going to be getting. So obviously there's going to be a big change potentially in the mining infrastructure side. There's going to be miners who are higher cost, who are less efficient, who are going to have to go out of business or at least put it on hold because the rewards they're getting for the effort are diminishing by 50%, as you know, from halving. And that may see things like hash rates come into play. You're going to probably see more miners or fewer miners getting a higher concentration of the coins on offer. But what it's not going to do is change the amount of coins that are in circulation. So essentially, there shouldn't be a liquidity event. It's not like we're going to see the halving and suddenly the Bitcoin price goes, spikes up in any kind of dramatic fashion. And that's what we've seen in the prior 3 halvings. So it's definitely something that is psychologically important for the market from an ecosystem and the actual mining itself. And it's going to make it more difficult and less rewarding, should we say, to get those coins. But that's something that a lot of people are obviously going to be watching. From a technical perspective, we are still sort of just moving a bit sideways. I think it's good that we've managed to regain these highs, but I'm not certainly haven't got any really strong bias at the moment. We do seem to be trading 72.50 right down into these low 6,200. So a decent range, but it seems to be sort of just moving sideways at the moment in that situation. And we'll see what happens from the halving. If I want to have a look at what we're seeing from earnings as well, I talked about the different stocks that are playing through. One stock that I want to look at is Netflix. This week we've got, Goldman Sachs are going to be coming out tonight. We're going to have a load of regional banks, so put the KRE ETF on your radar. The sort of expected move in Goldman Sachs for tonight is 4.3% up or down. That's the options pricing. Tomorrow we get Bank of America. They're a sort of very, very important bank in America. We're going to have United Health. I talked about the importance of them for the US 30. We've got Johnson & Johnson, Morgan Stanley. Netflix, as I say, an interesting stock. The options market's expecting an 8% move on the day of earnings. The stock's had we're up 27% year to date. So obviously a big outperformance relative to the S&P. But you can see after this big move, this big gap up, the price is now just consolidating between sort of 639 down to 602. So that just needs to work itself out. No position in Netflix at the moment, but I think one to buy on the breakout or sell on the breakdown there as well. We'll have to see. So the market's expecting a big move in Netflix. The market obviously loves to trade. It's a darling when it comes to earnings season because it does have these big moves and it has the propensity to trade. And then on Friday we're going to have MX as well. So they're probably the micro stories that we need to be focused on. But let's go around the grounds now. Let's have a look at what we're seeing. I think the first one. Let's go into the commodity because we're seeing so much flow at the moment in the gold price. And I want to bring that one up quickly. Where are we here? Well, big candle on Friday, but what we need to keep is those lows in place there. We can see last week's low. If we take the weekly move, and you can see last week's low coming in at 2,000. What's it? 2,302. I think that level needs to hold. Unless we can see a break of that level, then I'll probably turn a little bit more bearish and looking for a short-term down, a bit more of a drawdown, a bit more a pullback. But as long as those lows can hold, I think we can stage a continued move higher. The other factor is that we've got this 5-day exponential moving average, which is really contain the sell down that we've been seeing. We still continue to hold above that. I think if we saw a daily close below that short-term moving average, then perhaps we're going to see a bit more chop, a bit more sideways trade, maybe we trade a red of a range. But for now, as long as price can hold that, then we're still taking a positive bias on that. And if we can get a break above 2,376, depends on what happens with the geopolitical headlines, I'd look at re-establishing momentum longs in that situation. So we are seeing a bit of chop. But as long as those moving averages, which have been a really good systematic driver so far, continue to hold. So still taking a modestly favourable bias on what we're seeing in gold. But really, the gold price has seen its strongest correlation with the Brent price and crude at the moment. If we have a look at spot Brent, it's chopping around. Really doesn't know what to do at the moment. Above $92, people are looking to sell into it. And above, into $89. So I think we're finding a nice little range. I think the thing is what we're seeing here is, unless people genuinely thought we were going to supply issue coming through and constraints playing through, then oil prices have got significant upside if we're going to see that. But that's not likely to happen. And I think people are refraining from believing that we're going to see a supply shock. In fact, as we go into the next OPEC meeting on the 1st of June, if the price was to move a little bit higher, there'd be sort of lots of reports coming through that OPEC would look to allow increase in production. Obviously, they're capping production at the moment about 5 million barrels a day below where capacity could be. So, that's something that we're looking at very closely. But the Brent price just chopping around after a strong move up, and obviously seen that situation playing through in gasoline as well. We're just sort of consolidating now. I think copper looks quite interesting. Let's go into some of the other markets here. Corn. Yeah, one to put on there for momentum traders out there, for breakout traders, and of course all trends start in breakouts. This is quite an interesting one, above 432. If it breaks and closes above that could have an interesting trend coming through. Sugar, like this to the downside, this is really getting momentum. That 5-day exponential capping things at the moment. So I think sugar's got some pretty good downside playing through. Not really seeing much in that one. What am I saying? Copper. What is it? Coffee. Big range there. I think if we can break through 218, through these lows here, then I think we'll probably look to see a bit more of a drawdown, maybe looking at short positions through there as well. But some interesting moves playing through in the commodity markets. What we're seeing now, a little bit of a reprieve. I think the US dollar is a little bit oversold, a little bit overbought, but I think rallies are there to be or sell-offs in the US dollar are there to be purchased. In my opinion, I think if we have a look at euro dollar, we had a look at the policy divergence that's playing through and the other factors that are getting it real tailwinds. But I quite like this one. I wouldn't mind a little bit of a move up into sort of the 106.70, 106.85 levels, just to see how we sort of retested into this former breakout area. Obviously see it, but I don't think it's going to get there myself. I'd be very sceptical that we can push up to there. But if we did, and then obviously we're looking at how price action plays through. Dollar yen obviously getting a lot of focus at the moment, as with the yen crosses. Reese, I'll look at sterling yen at the moment. I want to look at cables specifically because this is now trading at the highest levels for years. Are we running intervention risk? The tactical play for problem with dollar yen traders is that you don't really want to be short because the fundamentals are there, and it's really the Bank of Japan and Ministry of Finance, more importantly, are fighting very, very strong fundamentals for the US. I'm not sure we're going to get intervention really until we get to 155, but we're getting to the point now where we're going to see a lot more headlines. We've seen loads of headlines about potential intervention from the Ministry of Finance, but it's the time when we see a headline saying that we're checking rates. That's the point. That puts us on firm notice that they're ready to look to intervene. We haven't got those headlines yet, but when we do, then I would be moving firmly to the sidelines. Let's have a look at cable. That again is just broken out. We had this really strong range. If we have a look at a weekly chart of cable, we can see that really well-defined range. If we put a Bollinger Band on that one as well, we saw some of the tightest conditions last week in the Bollinger Bands. Obviously looks at the 20-day moving average, or 20-week moving average in this case, and has a look at the movement away from that mean and 2 standard deviations. We saw the tightest Bollinger Band since, I think, 1977 last week. So, obviously when we get that coiled spring, volatility can really manifest. We don't know which way that's going to be, but it can be quite striking. But now we're seeing that breakdown. I think this trend's lower personally, but obviously with momentum and trend, you don't know it's going to happen. No one knows the future unless you're insider trading. But there is the propensity for this to now start bear trending. So I think that's quite an interesting trade as well. But let's have a look at sterling yen. Again, I mean, there's so many of these yen pairs at the moment, which is working quite nicely. A lot of it really depends on volatility and why you'd be using the yen as a funding trade. Aussie yen's been working really nicely recently. But I like sterling yen. I quite like this one a bit higher. If this kicks through 192, then I'd potentially be looking to add to long positions, just putting stop losses, very aggressive stop losses below 189.85, just below these pretty lows. You know you risk how much you're risking in those positions. But it's just been consolidating. You can see a couple of inside days here, inside bars. If this can break out through those top side through 192.50, I think this can start trending again a little bit higher and push it. Obviously, it comes with risk when you're shorting the yen because of what potential Ministry of Finance intervention. So if you were looking to short the Japanese yen, do be cognizant that we could see some major headlines at some stage, and you could see you'd be on the wrong side of that. So that's obviously a tactical situation. The Ministry of Finance and the Bank of Japan obviously want to ward off people looking to short that, and so that's a big implication for you if you are looking to go long some of these currency pairs as well. One we like, dollar Swiss, very, very strong move up there. I think pullbacks will be pretty minimal. I think this one continues to trade higher in the short term. Aussie dollar getting a bit of a workout to the downside. Again, this is something that could crack. So still pretty positive on the dollar and some of these pairs that we've been seeing. I want to have a look at the equity markets here. Let's have a quick look at the Hang Seng. We've got this really nice regression channel, bear channel that we've been seeing. But the Hang Seng's just trading in this range here, 17,196 down to 16,309. I think it bounces around in that channel, to be honest, in that little, there's a little range it's found for the last 6 days. Actually, sorry, 6 weeks, that's a weekly chart. Let's put it on a daily chart. You can see that. You can see that range. I think you've got a really nice little established range. Play the range for now, but if it breaks out, I think that could be quite meaningful. I actually want to see this breakout top side, and I think if it breaks out through this channel, you could see a lot of traders looking to chase this one, people from the mainland and also from Hong Kong looking to chase this one higher. I think that could start trending if it broke out through the channel. But this is one that's found a nice little range, and I'm just waiting. We've got this on high alert at the moment, just waiting for a trade to play out. Let's have a look at US markets quickly. Nasdaq actually holding in quite well, despite all the doom and gloom that we're reading. It's still just chopping around. There's really sort of very little for me as a momentum trader and a trend guy to look at the moment. This feels like it's just got some chop still to play out. So, yeah, looking at sort of more aggressive long-short strategies within this market and waiting for the market to sort of push you. But I think there's going to be some opportunities to take the time frame down and just work within that channel. And then we can have a look at the US 50. This is starting to look a bit more precarious. So you've got this downtrend that's in place. And yeah, that needs a bit of work if we're going to make all-time highs there. But we've got a really bearish mood there. I think if it break through these lows, then I'll be looking at momentum sell orders to play through there as well. But again, it's been very difficult to short US equity markets because you get one down day, the next day it's up, and it's been very unrewarding to be short unless you're trading on sort of 15, 30-minute charts. For those 4-hour day charts out there, it's a bit more of a tougher situation. But we're just sort of taking a fairly cautious stance on US equity markets at the moment. Nasdaq is, as I say, slightly a slight exception there. So what we've got this week, we're still taking a favourable bias on the US dollar. It has that exceptionalism story. It has the relative rate differential story playing through. Gold prices, we talked about what's happening in there. The geopolitical risk is clearly the big driver at the moment. The fact that gold prices is going up in a rising US dollar and rising real rate environment is very, very interesting indeed. We've got our eyes on geopolitical headlines. There's not a huge amount of data to really drive unless you're looking at the UK, probably China. We've got all these Fed speakers playing through. It's another week in the markets. I'd love to hear some of your thoughts on what's going on. Trade at Pepperstone.